What's up, everybody? Jdew and Jonah of the Cash Compound. We're the Banking Bros. And on today's episode, we're going to talk some terms of insurance. Hey, what's up, Jonah? I made a little pun in the opening piece. We're going to talk terms of insurance because we're going to talk a little bit about term insurance today. Are you ready?
Yeah, the episode today is going to be centered around term and the main differences between whole life. Maybe we'll tackle some myths that are out there.
Yep.
People talk a lot about term insurance and the benefits that it has. We like to talk a lot about whole life insurance and the benefits that it has. And there's all sorts of insurances in the middle. Maybe we'll touch on a few of those as well.
Indeed. The reason we're coming to you with this type of topic today is because, ladies and gentlemen, we're here to crack the code to cash flow for you. Cash flow is not normally something we're talking about when we're talking about term insurance. So lots of you out there have been undereducated about what insurance is when it comes to life insurance, and we were in the same boat. So we're going to help you understand what is going on, what's true, what's not, and just clear those things up for you so we can get the terms right today and help you crack the code to cash flow, save your money, spend theirs, and how all that works into life insurance. All right, Jonah, so I've got the old Google up here, and we're going to dive into first the definition. I keep saying the term of insurance. Here we go. So we're talking about life insurance here. Term insurance. Investopedia says term insurance is a type of insurance policy that provides coverage for a certain period of time or a specified term of years. Is that hard to understand for you?
No, it's basically saying that if you get term insurance, it's going to last for a term.
A term, right. Okay, so here's the question. Let's take it back here and let's just dive deep for a second. Do you remember when you first learned about life insurance at all? Like, how did you learn about it? Who was talking about it? Were they talking about term? Anything like that?
I'm not exactly sure when I first learned about life insurance, but I could probably say with confidence that they were talking about term insurance, yes.
Okay, now why is that? Why do you say with confidence? What are the normal things people are saying? What do agents out there have to tell their friends and family members about insurance, life insurance?
Yeah, generally speaking, and I'm sure, again, I just don't remember exactly, but I'm sure this was the conversation subject when they were talking to me about it, is you want to make sure that your family members have a bunch of money after you're gone. And the most inexpensive way to do that is by getting term insurance. Again, they'll, if when they're talking to you about it or offering it to you, they'll say things like, for $10, $20, $50, $100, you can make sure that your family will have $10,000, $50,000, $100,000 after you're gone. And then, of course, they promote that really heavily around the time that you're maybe dating someone, maybe about to get married. They promote it really heavily around the time you maybe are buying a house or something like that.
Having kids,
because they say, they kind of pull on your heartstrings.
Yeah.
They go, if you were to pass away, is your spouse going to be okay?
Yeah.
And then they say, nope, you need,
obviously
you need
not
all this money.
Right. Unless you've got $100,000 or $1 million sitting somewhere semi-liquid that your spouse can get to, like, they're going to be in trouble because it's an idea of a loss of income for them.
Yeah. Or
you have debts, like you bought a house, and they need to take care of that now because you're not around.
Right. They also like to promote that when you're somewhere. I feel like when I see it most, people are trying to promote that somewhere in between the ages of like 19 and 25. Because it's least expensive during that time, and you can get a really long term. And
okay,
so a lot of times we see it.
Break it down for people who are listening to us who may be at the very beginning of the stage. Why in the world would that be least expensive? Why would it become more expensive over time? What does your age have to do with it?
Yeah, well, when you're buying insurance for a specific term, and I believe the most general terms are 10 years, 20 years, or 30 years, you can buy this insurance for. The reason it's least expensive while you're younger is because you're more likely to still be alive in that term. So they don't charge you as much.
So the insurance company has a little risk. They actually don't think you're going to die during that time.
Right.
The reason that you are getting it on an individual level is because I still don't want my family to bear that burden.
Right.
If I die early or accidental or whatever, unforeseeable, because I don't want to carry the weight of $500,000, $1 million for them. Like, I'm not carrying it.
Exactly.
So I'll offshoot it to someone else, the insurance company.
Yeah.
Okay. The other word you've said a couple of times here, I think you said it twice, is promoted. So that is an interesting idea, because when folks are marketing insurance, a lot of times this is this type of stuff you hear commercials for, and things like that.
Yep.
So where will people be hearing and seeing this type of stuff, and what will some of that terminology be, maybe if different at all? Because I agree with you, this is what's promoted the most.
Yeah, so I mean, you can see it in the commercials, like you just mentioned. I'm a big basketball fan, so I've been watching a few of the basketball games lately, and there's insurance commercials. And
yes.
Our guy from State Farm has a lot of commercials during basketball games. Right?
Yes.
You also see Progressive and all sorts of stuff, right?
Right.
But there's lots of commercials. You'll also see it, so we mentioned, when you're purchasing a house, they promote it really heavy. They literally send you mail. I don't know how they get your address. I'm sure.
Public record.
Yeah, public record.
Probably.
Somebody knows. But they literally will send you mail that says, you need to protect against your mortgage if you were to pass away. Here's the insurance you need.
Right.
So they've just coined it mortgage protection. It's just life insurance. That's all it is.
Right.
If you were to pass, here's the money your family needs to pay.
So we letting y'all know this a little bit out there.
Yeah,
secret they don't want you to know is
pro tip. Mortgage protection is just life
insurance. It's all life insurance. So mortgage protect, business protect, blah, blah, blah. You can protect whatever you want. It's cash.
Yeah, it's just money. They just coined it. Protection against
Which
the mortgage.
is good, because it helps sometimes you or me understand what we need to be protecting. The fact that there's a house your family might lose, or they should pay off, or they might need to move, and we got to get out from being underneath. Yeah. So that's a cool thing. So just letting you know, it's still life insurance.
Of course, if you know anybody that is selling life insurance, they generally would do their marketing for you in that specific age or that time period. Getting married, they just look for that stuff. And again, public record, or maybe their friend list from Facebook. That's what they're looking for, because it's easier to sell that to a person.
Major life changes. You got to understand something out there, that when you add on to your life in terms of depending on someone's income, you now have dependents. There's other people who will be left behind, as the old books say. And when you add a spouse, when you add a house, which is normally a long-term commitment, right, that you didn't cash out with, or you have now kids, dependents, right? They need to be covered. Yeah, maybe you're making the money out
all
there.
Sorts of things, right? So general, when you think about working a job, W-2 employee, there's a certain amount of time during the year where you can opt in to the benefits of your job. And generally, there's going to be some sort of life insurance tied if you've got a full benefit package. But at the same time, that's also the time that they are reminding you, oh, here's all of the things that we do, and you might need life insurance, right? So you see it. I mean, there's just certain way. They're really smart about how they promote it, but that's when they promote things. That's how they sell it to you.
And see, there's nothing wrong with promoting these things and helping people understand them. Lots of people are underinsured. Think about it like this, and then we'll move on to the next idea. But you really need to take a moment. If you are not insured in the life category or underinsured, that you have a certain economic value. Every day, month, week, and year, you're making money. And if you're not there, those people, dependents, those social programs that depend on getting your dollars will not get it. You have value, and it's economic value. And if you are subject to loss over the course of a term of time, and those dependents would not get the money, would you insure the fact that you could still get the money?
Yep.
I think you should. I really think you need to think about that, because you are your greatest asset. Your ability to produce and have value in the world is a big deal, folks. So that's why insurance is important, in terms of the simplest way to make it happen.
Cool.
Now, also, you mentioned 19 through 25-ish. Now, my buddy came out of schools, got that life insurance license, and he called me up. Same thing. Explained to me some of the things that we've said here. And he gave me paperwork. I told him my numbers and my income at my job. And I said I wanted to be married one day. And he said, you need to make sure you lock it in now. And I was like, bro, you're exactly right. Right. So I got myself a term policy. I don't know if you've ever had term. I had a term policy that I bought from a buddy, major insurance company, $400,000. Okay. If I died in a 30-year span, I think I was 25 at the time.
Okay.
25 to 55 cost me something like $20 a month.
Yep.
No big deal.
Sounds about right.
Yeah. Did you ever have term?
I don't think I ever had term.
No. Okay. All right. So you were underinsured.
Coming out.
You're subject to loss here.
As soon as I turned 18, and I'm an adult, underinsured, I would agree.
Okay, so what's crazy about this is if you had died who was supposed to take care of you? Was it me?
I guess it was mom and dad.
All right,
I
good.
guess it
Because
was, right?
look, it costs a few dollars to put you in the ground, right? Go to your apartment and clean that mess out.
I agree.
Okay, I would have taken all your clothes though, for sure. Okay,
So that's term.
yeah, that's a little bit about. Now I want to get into an exercise.
Sure. Go for it.
Okay, so what I did is I Googled it, and I wanted to see what people were doing these days out here, because a lot of people ask us, hey, what's the coverage? What's the death benefit? How much does it cost to do what you guys talk about, which we haven't gotten into on this episode yet. But I started to look it up because I hadn't looked at these things in a while. So I looked it up and I found something that popped up right away. They're ready for you. Policy Genius. I've heard of this.
Okay.
And
is it like shopping a bunch of different
yeah,
companies?
I
Okay,
think
cool.
so,
Yep.
or whatever. So I put in my info here. Okay. You may have seen it here on the screen, but I moved it. If I wanted $500,000 of coverage, I'm 38. I'm a non-tobacco user.
Okay.
I'm 5'9", 160.
Ooh, you need to put on some weight. But okay.
What? No, they didn't say nothing about that in here. Okay, so I put that information in. Spit it out real quick.
Yep.
Spit it out real quick. How much do you think a 30-year term? I gave you some general numbers a minute ago. 25 years old, $20 a month, I think.
Yeah.
And it was like $400,000. So how much if I want a I think it was 30-year term. 30-year term policy.
$500,000.
$500,000, a little bit more than I had before.
Honestly, if you were at 20 before, I'd put you at 30 to 35 now. Not that much more expensive.
Okay, according to this, I'm seeing an estimated price of 43 at the lower end.
Yep.
Okay, $43 a month, and then over the course of the term, I could be covered if I became a loss and a statistic.
I wasn't that far off?
No, not that far off at all.
Yeah.
So now there's a big difference we want to get into as we go into the comparison, but we're not quite there yet. We want to help you understand that we're not able to utilize this particular life insurance policy type for what we do. Because at the beginning of this episode, Jonah, I gave them our mantra, crack the code to cash flow.
Yep.
Cash flow. Now tell us, first off, is that possible over here? Why is that or isn't that? Why won't we talk about term then, normally?
Great question. Term life insurance does not have any equity value. There's no cash that's built in term life insurance. It is as simple as we've talked about it in this episode. You pay money. They give your beneficiaries, your family, friends, church, or charity, a set dollar amount if you pass within the term. That's it. I haven't had term like we just talked about, but if I had to guess, they're putting the contract to that term on one page, 2 pages. That's it. There's nothing else going on.
It's why it's very simple to buy it.
You can Google it, spit out a price.
Pop.
Like that's it. That's all that's going on.
Yeah.
So there's really some key differences between term and whole life. I actually pulled up on my own side here, Investopedia myself, and it has key takeaways. So I'm literally just going to read it, okay? Right. It says term life is pure insurance, whereas whole life adds a cash value component that you can tap during your lifetime. It says whole life, however, lasts your entire life and accrues cash value that you can borrow against or withdraw while still alive. Mm-hmm. It says death benefits from either type of policy are granted income tax-free. The cash value inside a whole life policy also receives favorable tax treatment.
First off, I want to remind everybody out
right here on Investopedia.
Yes, and this is on the internet. This is not talking about what a lot of questions people give us. Which company?
Yeah.
This is not talking about, that don't work.
Right.
Investopedia says this is what it is.
Absolutely.
Folks in the DMs, come on, we're talking to you. We want to help you understand. That's and first off, it is this is the definitions of what these insurances are and what they can do. It's that they've been so underemphasized that people don't know how to use it or They actually tell people it's impossible.
Most in the world out there today, in the market, and your friends, your family, your HR from work, your things you're reading on the internet or seeing in the media or listening to on the radio, people say you shouldn't get whole life because it's more expensive. But when they say that, all they're chatting about is the death benefit. That's it.
And meanwhile, what did you just read that this thing could be done?
So here's the first part, right? We agree with them. It's more expensive if that's what your intention was. But if your intention was the whole life accruing cash value that you can borrow against while you're still alive,
tell them.
And the cash value inside whole life also receives favorable tax treatment,
tell them.
then what they
Let
just
them know.
said doesn't make any
Right,
sense.
because it's a different product. We're buying it for different reasons.
It's a different reason they're using the product.
I like dessert, but there's cake and there's ice cream. Depends on what you're into.
Exactly.
They do different things.
Well, cake is cheaper.
Yeah, well, it depends.
Yeah, but I wanted ice cream.
I wanted some pie. I wanted some ice cream. I wanted something different.
To do with.
Yes, these are different products. Yes,
I wanted ice cream.
Cake is often warm,
right?
You know, ice cream is cold.
Oh, so if you're eating dessert, you got to eat one that's warm. I wanted ice cream. I
need it to be cold. I need it to do different things for me.
Different.
Right? Okay.
And so they say that like it's a blanket, like it covers all, and it's just not. Like it's not even close.
Right.
So we've come up with something that's been very helpful, and we're kind of teaching people the difference between term and the difference between whole, and we realize it's a whole lot like the difference between renting and the difference between buying.
Yes. Now everybody knows those things. First off, let them know, Jonah. So renting and buying, what's going on?
Okay, if you're paying rent, that means you do not own the place, right? Someone else owns it. You're paying for use of that spot.
Yes.
Renting generally is going to have a term of time, a year contract, 6 months. Maybe you signed a really long lease, 2 years or 3 or something.
It's got a lease. It's got a term of time.
A term of time.
Right.
Generally speaking, the rent, the lease, the term of time can increase on you. Like the price can go up. Right.
Yes.
If you renew, like if your term runs out of your year,
then it's a new deal.
New deal. Right. So your price can go up, and there's absolutely no equity value. There's no ownership there.
You have use of it while you're paying for it during the term.
Right.
Everyone's cool with this.
Everyone knows how that works.
Right.
Lots of people rent.
But what's crazy, Jonah, you just said that, hey, term is cheaper than whole life.
Yeah.
But you see people out here mostly saying things like, renting is cheaper than buying, so you should just rent.
Right, and that doesn't make sense
because we want to own for different reasons.
If you want, right. if you need a backyard for your kids to play in, and the place you're renting is an apartment, it doesn't matter that renting is cheaper than buying. I have to go buy. I need a yard. Like I got kids. You know what I mean? It doesn't make sense.
We've been trying to tell folks
that renting is the same as term insurance.
Yes.
There's a contract. There's a term of time. There's a lease. Yep. You don't have it forever, right?
Correct.
In term insurance, you're picking 10 years, 20 years, 30 years, generally speaking. In renting, you're picking 6 months, a year, 2 years, whatever you're picking, right? Mm-hmm. That's how it works.
Right.
There's no equity value in term insurance. There's no cash. You don't own this thing. In renting, same thing. There's no equity value. You don't own this. It's not yours. And third is, on the term, when the term is over with term insurance, they can increase the price on you. It's a new deal. The term's over. That's what you just said, right?
Yeah.
When you got your term at 25, it was $20 a month. When you're just looking right now at 35, you're saying it's $43 a month, right?
Right.
Term went up. Price went up. Same thing with rental. The price can increase if you
and of course now take it back to insurance there for a second. Part of the reason that it has to go up is, remember that the insurance company has to pay out the big number, the death benefits, at your demise if you die during that term, right? So as I'm older, is it more or less likely that I'm closer to dying?
More likely.
More likely. So it costs more because they know I'm closer to dying this time. The people are not, and the older you get, the easier it is to understand that. Like, you don't expect 90-year-olds to live 20 years.
You do not.
But you do expect 20-year-olds to live 20 more years.
That is correct.
So that should be simple.
Yep.
Okay, here we go. So now let's get into term insurance and whole life insurance and help people understand what this cash is about, how we can get to cash. Why is there cash inside whole life?
Whole life is a lot like buying a house, purchasing the property, right? Mm-hmm. Here's why. You own it. It's set. Like you can decide whether there's no term. It's not ending on, you don't just magically lose ownership of your house next year. There's no term.
Right.
You
it's
own
yours.
it. It's lifetime. Same as whole life.
You got a guaranteed contract. The deed.
Guaranteed. It's promised to you, right? Because it's promised, there's a guaranteed payout at the end. You have to pass away at some point. So if you've bought something that lasts for your whole life and your whole life is only over after you pass away, then that thing that you bought that lasts for your whole life is guaranteed.
Correct.
Until you pass away, right?
Yes.
And of course, when you pass away, your family gets the big payout. And so the key difference here, just like the internet's saying, is that because you bought it, because you own it, there's equity value, cash value that builds, just like in homes. Everybody talks about that all the time. HELOCs, home equity lines of credit, right? How much equity have I had in my house? You know, I've been in here for 5 years, 10 years. Here's all the equity I have. Because you own it.
Yes.
It's the same thing with whole life.
And what's crazy, I'm just realizing this, I think we both are, because you laughed earlier, is how similar it is in these other cases, like home purchases, but people don't get it. They still want to kind of argue. And it's like, people, you know how this works.
Yeah. You've never related that idea to this concept.
Correct.
You know exactly how this works.
It's the same thing with general insurance.
Yeah.
They ask us crazy questions about insurance. It's like, bro, you buy insurance and you pay for it every month on your car.
Right.
Why are you asking me like this is some sort of new magic Harry Potter world?
Right.
Like
You
already do it.
Yeah, that's how it works. So it's one of our questions we get often. We don't get it often, but sometimes folks ask us, man, if all this is possible, how does the insurance company make any money?
Bro, you already do this.
And it's like, what do you mean?
You do it every month.
Yeah.
You've been giving them money every single month for different types of policies.
Right, exactly. But anyway, we're here to talk about whole life. And
we just out here fronting
whole life.
Like you're crazy, but we're helping you learn.
Whole life and purchasing a house and purchasing whole life policy are so closely related.
Yes.
It's the same thing going on. If you buy it, if it's guaranteed, if it's going to last forever, there's no term, then it's going to build equity value.
Yes. So remember, let me break it down in a different way in the 3-cup setup analogy that we love so much. Red cup premiums, blue cup death benefit, green cup cash. If you're putting something in premiums, Jonah, and it is going to guarantee whole life a death benefit, then you've put in dollars that bought that big pot of money. You've bought it. It's guaranteed. The reason people don't think about them buying that money and getting it very much is because they are going to die. They're normally thinking about them being the insured body, the coverage. But because it's purchased and it's guaranteed, that's why we're growing equity toward that money.
That's right.
Each and every month, premium payment, year, whatever.
There's a very popular opinion out there, and you'll have to forgive me if I'm thinking actually of a book, but if I am, I'm sure you'll remind me, that talks about just buying the money for your family.
That's what we're exactly.
Literally, they talk about
ultra wealthy people, folks,
just to buy. They literally just talk about just to buy it.
Just buy your net worth.
Yeah.
But you're always thinking about it in terms of other people and protecting them. So you're not thinking about, well, you actually are buying your family's net worth. You can buy it today for $35, $45 a month. You can buy it because it's guaranteed to come to you.
Right.
You have to die. So ultra wealthy people have understood that for years, and they do not start GoFundMes for funerals.
Nope.
Because they bought the amount of money. If this guy dies, or guaranteed when this guy dies, we're going to get paid.
Yep.
How simple is that? Pennies on the dollar. We'll put in some pennies now, we'll get dollars later.
Right.
But they're going to die, so we might as well get the money. We got to think a little bit long term for this, ladies and gents. Cool. All right. Well, Jonah, there's one more type of insurance here, and I have got a comment of the week, and we are going to hear from someone from TikTok. All right. We got okay, whatever DD right here. I heard that Index Universal Life Insurance has fees up to 44% of premium payments. So once you stop making monthly payments, you could lose everything. A thought on that? Response?
I do have a thought. So, man, we're talking about all sorts of different types of insurance on today's episode, right? We're talking about term, we're talking about whole. I had mentioned earlier there's a bunch in the middle.
Yeah.
IUL, Index Universal Life, is one of those that's in the middle.
In the middle. I like that.
So here's the key.
Yep.
It's not whole life. It's in the middle on purpose. There's some other aspects going on there, and most generally, IUL, Index Universal Life Insurance policies, are built with certain aspects in them that would cause your dollars to not increase each year, right? There's some other things like annual renewable things that can happen. You'll have to walk me through fees because I don't use the IULs as often,
right?
Or really at all. I don't use IULs at all to build the whole life policies, the banking policies, and so you'll have to forgive me. I'm just forgetting about the fees.
So there's two types of fees: commission fees and also investing fees. Your dollars go into an index fund, and they follow and mirror an index. So once again, first off, I guess we're helping people understand. I like what you said in the middle of multiple types of insurance is they need to understand there are differences. They can't all be doing the same thing or else they'd be the same thing.
Right.
Okay, so there are differences. So I responded to this person, don't worry, about IULs. We just wanted to remind you that there are multiple types. This is not the episode to get into the details specifically on that type, but permanent insurance, whole life insurance underneath that umbrella is very important because that's what we're going to be able to deploy cash from. Term is a great tool for a different job.
Yep.
And that's not what we use here at the Cash Compound to build that banking system for you so you can build your wealth and grow, ladies and gentlemen. Appreciate you jumping in with us today to have a good time and learn.
Before our episode ends, we actually do want to give a shout out to our fan follow of the week. Our fan follow of the week is Mr. Tuck, coming at us from our YouTube audience.
All right.
So thank you, Mr. Tuck, for subscribing. If you're watching the video, what's up? Ask a question. Give us some feedback. We'd love to answer anything specific that you've got. We'd love to reach out to you. If you haven't reached out yet, we want to talk with you. We want to answer your questions. And hopefully we'll be able to communicate with you and anyone else watching about anything that got you confused or that's just still outstanding in your mind about infinite banking and practicing the infinite banking concept with use of these whole life policies. And other than that, I think that's our episode.
All right, let's sign off, ladies and gentlemen. We'd love to chat with you and crack the code to cash flow in your life. You can save your money and spend theirs, and we think that's a big deal.